Welcome back to What Changes. I'm your host, May. Today, we're diving into something that sounds like a conspiracy theory at first, but the deeper you look, the more it starts to resemble a strategic financial maneuver hiding in plain sight. America's national debt is now sitting at a staggering $37 trillion and climbing. That number is so large, it barely feels real anymore. It's repeated so often that it's lost its shock value. But here's the question nobody seems to be asking. What if the United States doesn't plan to pay off that debt in the traditional sense at all? What if, instead, there's a backdoor strategy, one that could instantly improve the country's balance sheet by trillions of dollars without raising taxes, without slashing entitlement programs, and without defaulting? And what if that strategy revolves around one of the oldest forms of money in human history, gold? To understand what might be unfolding, we need to stop thinking only about liabilities and start thinking about assets. Every time the national debt is discussed, it's framed as a one-sided disaster. 37 trillion in liabilities, runaway deficits, endless money printing. But the United States also owns assets, real, tangible ones. Among the most significant are its gold reserves. The US holds over 8,000 tons of gold, one of the largest sovereign stockpiles in the world. Yet here's the part that almost nobody talks about. On the government's books, that gold is still officially valued at roughly $42 an ounce. $42, not market price, not $2,000, not $3,000, 42. That accounting number hasn't meaningfully changed in decades. So while the world trades gold at thousands per ounce, the US balance sheet reflects a price set in another era. Now pause and think about what that means. If the government were to revalue its gold holdings, not even to a speculative number like $10,000, but simply closer to market rates, the asset side of the balance sheet would instantly swell. And if they chose to revalue it aggressively, say to $10,000 or even $20,000 per ounce, the increase in reported assets could reach between $3 and $5 trillion. That doesn't erase a $37 trillion debt, but it dramatically changes optics. It alters debt-to-asset ratios. It reshapes the narrative. And in a world driven by confidence, perception matters. Before you dismiss this as an internet rumor, consider history. In 1934, during the depths of the Great Depression, Franklin Delano Roosevelt executed a dramatic monetary shift. Gold ownership was restricted, the dollar was devalued relative to gold, and the official gold price was raised. The result? The federal government strengthened its financial position overnight. This wasn't theoretical. It happened. The United States has already used gold revaluation as a strategic economic reset once before. The precedent exists. Now fast forward to today. We are not just dealing with high debt. We are entering a new era of geopolitical and technological competition. The race for dominance in artificial intelligence, semiconductor supply chains, energy independence, and critical minerals is intensifying. Financial strength underpins all of it. If policymakers perceive that national security hinges on financial resilience, bold monetary maneuvers become more plausible. And that's where the idea of monetizing underutilized sovereign assets, like gold, enters the conversation again. Adding another layer to this theory is the growing discussion around a potential Bitcoin strategic reserve. Proposed legislation has floated the idea of leveraging national assets to accumulate digital reserves as part of a broader modernization of US financial strategy. If gold were revalued upward, that newly created balance sheet capacity could theoretically provide room to support such initiatives without directly increasing visible debt. In other words, gold becomes the foundation layer beneath a new digital monetary architecture. But there's something even bigger happening beneath the surface. The global monetary order is quietly fragmenting. For decades, the US dollar has functioned as the unquestioned reserve currency of the world. Nations traded in dollars, commodities were priced in dollars, debt was issued in dollars. That privilege allowed the United States to run deficits at levels that would collapse other economies, but cracks are beginning to show. Bilateral trade agreements are increasingly being settled in local currencies. Gold settlements between nations are rising. Strategic alliances are forming that aim to reduce dollar dependence. None of this means the dollar collapses tomorrow, but it does mean the era of unquestioned dominance may be shifting. In that context, revaluing gold is not just about domestic accounting. It could also serve as a signal to the world that the United States still anchors its financial power in hard assets. It reinforces credibility. It strengthens the negotiating position. It demonstrates optionality. When confidence becomes fragile, tangible backing becomes politically attractive. Meanwhile, central banks across the globe have been buying gold aggressively, over 1,000 tons per year in recent cycles. This is not retail speculation. These are sovereign actors positioning for a more fragmented monetary order. When central banks accumulate gold at scale, it suggests they view it not merely as a relic, but as strategic insurance. For individual investors, the implications are profound. If gold were officially revalued by the United States to $10,000 per ounce, it would not simply represent a windfall for gold holders. It would signal a structural shift in the monetary regime. A revaluation at that magnitude would almost certainly coincide with currency debasement. Your purchasing power would change. Asset prices would adjust. Bonds would reprice. Equities would recalibrate. It would not occur in isolation. And here's where nuance matters. Many people assume that owning physical gold is the only play in such an environment. But there's another layer. Mining companies operate with significant operating leverage. When gold prices rise sharply, their production costs often remain relatively stable in the short term. That means revenue expands faster than expenses. Cash flows can surge. Historically, during powerful gold bull markets, quality mining equities have outperformed the metal itself on a percentage basis. That said, miners also carry operational risks, management decisions, geopolitical exposure, and environmental regulations, so they are not a simple substitute for bullion. They are leveraged instruments within the broader theme. Silver adds even more volatility. It tends to move more dramatically than gold, both up and down. We've seen silver experience steep drawdowns, 30% or more, within short windows before rebounding. Investors drawn to silver's upside potential must be prepared psychologically and financially for that turbulence. Precious metals are not straight lines upward. They are cyclical, emotional markets influenced by macro flows, liquidity conditions, and sentiment shifts. Stepping back again, we need to acknowledge a larger macro truth. Prolonged periods of heavy government spending, especially when tied to defense, infrastructure, and industrial policy, are historically inflationary. Wartime economies, whether declared or undeclared, redirect massive resources toward strategic priorities. Supply chains are strained, commodity demand spikes, currency issuance expands, inflation follows. Inflation, in turn, erodes purchasing power. And when purchasing power erodes, hard assets tend to attract capital. We are also entering an era where financial repression becomes more likely. Governments facing extreme debt burdens historically cap interest rates below inflation to reduce the real value of their obligations over time. Savers earn less than inflation. Bondholders lose purchasing power slowly and quietly. It is not dramatic, it is subtle, but it is powerful. In that environment, assets outside the traditional bond system gain appeal. Now, none of this guarantees a $10,000 gold revaluation tomorrow. Policymaking is complex. Political constraints exist. International coordination matters. But the concept itself is not a fantasy. It is grounded in accounting reality and historical precedent. The United States could, by executive or legislative action, alter the official book value of its gold holdings. Doing so would not magically eliminate debt, but it would alter the narrative and provide additional balance sheet flexibility in a high-stakes global environment. The most important takeaway is not to fixate on a single price target. It is to recognize regime shifts. For decades, we operated in an era of declining interest rates, globalization, and relative monetary stability. That environment may be giving way to something more fragmented, higher structural inflation, strategic industrial policy, regional trade blocs, and digital asset experimentation layered atop traditional monetary systems. In such transitions, assets that sit outside the pure fiat system tend to regain relevance. For you, the viewer, the question becomes positioning. Are your savings entirely exposed to currency debasement risk? Do you understand how your retirement accounts would respond to sustained inflation or a sudden monetary reset? Have you considered diversification beyond traditional financial assets? These are not fear-based questions. They are strategic ones. Ultimately, whether gold reaches $10,000 through official revaluation or gradual inflationary repricing, the direction of pressure is clear. Governments burdened with unprecedented debt loads historically choose debasement over default. It is politically easier. It spreads the pain invisibly over time. And in that environment, assets with scarcity, gold, certain commodities, and even carefully selected digital assets become relatively safe havens. We are watching a system under strain. Debt levels are extreme. Global competition is intensifying. Monetary experimentation is accelerating. The possibility of gold revaluation is not guaranteed, but it is conceivable. And when something moves from impossible to conceivable, prudent observers pay attention. The shift may not be announced with fireworks. It may unfold gradually, or it could arrive suddenly over a weekend, with a policy statement that resets assumptions overnight. Either way, the structural forces are building. Hard assets function as insurance, not speculation. They are not about getting rich quickly. They are about preserving optionality in uncertain times. And in moments of systemic transition, optionality is power. If you found this breakdown valuable, stay connected for ongoing macro analysis and strategic insights. The financial landscape is changing faster than most realize. Preparation is not panic, it's prudence. I'm May. This is what changes. And in times like these, staying informed is your greatest asset. Stay prepared.